Hello and welcome to another episode of the Investor Financing Podcast. And we have a great episode where we talk about East Coast real estate. We've got a great guest today. We're going to talk about value add. We're going to talk about what's happening in the market from an underwriting standpoint, from an operator. Please welcome, and I'm going to say his name incorrectly, Anthony Scandariato. Anthony, prior to forming Red Knight Properties, was co-founder in Ridgeview Partners. He specialized in the retail space with a vertical model that provided flexibility to serve multiple customer segments with similar product lines through retail, wholesale, and production contracting channels. Later moved on to acquisitions and asset manager, vice president for Vision Properties, where he was directly involved and responsible for sourcing negotiations and managing the acquisition of close to $600 million in Class A office assets. Welcome to the show.
Leading to the segue, I run Red Knight Properties right now. Came from Class A office background, and then now I'm focused on multifamily. For the most part, multifamily. We're a value add boutique, middle market multifamily investment firm. We also do property management in-house, but we have about a little bit under 1,000 units at this point, about maybe 110 million in AUM in four soon to be five, but four different states at this point.
And you have a podcast called Discovering Multifamily. All right. Well, welcome to the show. Thanks for joining us. So let's kind of dive in. You had an extensive background in commercial real estate, and you were working for some pretty savvy sponsors, and then you decided to go out on your own. And when you first went out on your own to do your first, did you go straight into the syndication world pretty much, or did you do your own deals first with JV partners?
Yeah, I actually bought my first. I bought a duplex in 2016. I was still working full time. I left the full time job basically January 2020. So I was there, 6.5 years, and I bought my first duplex in the same town where I grew up in. So I was able to go to the property pretty much every day. I was still living in the town at the time. So really manage it myself, had to evict the tenants, did a self-eviction, learned a lot, renovated the apartments myself. So learned a lot from there, and then just kind of scaled up after that first deal. This is all part-time. Was scaled up, started from a 2, bought another by myself. Had success there, bought another 2 with a partner. We flipped it, had success there, and then bought a 10 with my now business partner. Ended up executing our value add plan there, did a cash out refi instead of selling. And we bought about 70 units together over a 2-year period, still working full time, and then decided to go into larger deals, larger multifamily opportunities, 50 units and up, kind of that $5 million to $20 million purchase price range. And, ended up having to put capital together for that first deal kind of towards the end of 2019, closed on that. And then ever since then, kind of been building up our portfolio, basically quadrupled the portfolio over that, kind of 2-year time period from 2020 to 2022 now.
And territories, it looks like you're focused. You have some holdings in Florida, Pennsylvania, and New Jersey and New York. Is that kind of your core markets you're looking at?
Yeah, I mean, my company's based in New Jersey. We have, staff in those states at this point, looking at some other areas as well. But we started out at our home base in markets we knew very well in New Jersey, and then kind of expanded from there. We expanded from New Jersey to Pennsylvania first, because that was kind of a natural progression, since you can drive there within an hour to an hour and a half. And then I bought in the Florida market as well. I'm actually selling some of the Florida market right now that we acquired. But I was doing deals in those Florida markets and other states like Georgia, Kentucky, Maryland. At my prior firm, I was very comfortable with the markets. So kind of applied my knowledge base from the markets we were already in to what I'm buying now. And yeah, 4 different states, but mostly up and down the East Coast. I would say we're looking at some Midwest states right now, but that's where we're at.
Got it. And so when you're saying you're selling in Florida right now, is that because you took the property full cycle, or are you just thinking that it's had such a good run up that you're crazy not to sell right now because the market's just been on fire?
A combination of both. The value add was executed, and obviously the market's on fire right now. So got the best of both worlds.
Yeah, no, that's true. And I guess rolling into that question, the market's crazy, right? We have a lot of like exterior factors. There's shortage of inventory. There's still demand. Prices still keep going. Rates have gone up. There's a war going on. But all the indicators still, in my book, shows that it's going to be a pretty good residential real estate market. Do you agree to that, or what's your kind of thought process on the market right now from an operator standpoint?
Yeah, I mean, I agree. We're not going to see 20% year over year rent growth that we've seen for the past 2 years. So we're not underwriting any of that. We never underwrote that before, but I do see operators underwriting that. We're not going to see 8% a year either. Once the supply chain kind of calms down and, inflation is, kind of under control, who knows when that's going to happen, but it will happen at some point. And, that's what history tends to repeat itself. So when it does happen, we're just not going to see the same type of rent increases that we've been seeing. So we're being very cognizant of that. And as you said, there's this, supply and demand problem. I mean, the country was shut down for, at least a good year. Construction, was kind of to a halt. So there hasn't been, any really new supply. I'm sure some projects got finished, but we're still on the apartment side, 500,000 units short, each year to keep up with demand. And I think on the single family side, it was like 3.5 million homes are short right now. Just reading statistics yesterday. So there's a clear supply and demand problem. We specialize in what I like to call workforce housing segment of these markets. So we're not really investing in gateway, like downtown CBD Class A. It's usually within an hour or hour and a half of a major market, metropolitan area, and more secondary suburban, maybe infill type of product, garden style, 1 to 2 story walk up buildings. So it's a little bit different than some other operators' philosophy in terms of where we're investing and what type of product. But we've been seeing the product hold up very nicely, even during the pandemic and now, even before the pandemic. So it's I like the lower end apartment buildings, Class A rents. Although they've been kind of recovering now, they did get rocked for 2 years, especially in markets like New York City and San Francisco, LA. I still think they're down from the peak in end of 2019, early 2020 by at least 4% or so. So we're looking at many different factors: population growth, employment growth. That's number one, the employment base and the growth. So for us to divest and diversify out of our home state of New Jersey into the Sun Belt states where a lot of the growth is happening, some of the Midwest as well. It was a smart move on our part. I like to say, like to think so.
Yeah, no, I like that. I mean, that's what I was just telling you before we went live. I just found some kind of tertiary markets. I was finding small duplexes, fourplexes, and there's not as much competition. It seems like most investors want to be in like the markets where they think everybody, and I think there's a huge opportunity because in workforce housing, that's what I believe in, the same kind of investing model that you have right now. I think that's like the tried and true. And so you're finding value add deals in these kind of tertiary markets. And like, how small of a market will you guys go into, like a population of 10 or 20,000, or does it have to meet certain benchmarks for like before you were buying smaller properties, now you're buying, it seems like 50 and above. But for any like smaller operators out there that might be doing 10 or 20 unit properties or even fourplexes, were you not afraid to go into those smaller markets at the time, and those have played well for you in the workforce housing market?
Yeah, I mean, if we're looking at larger complexes, you're generally going to have a population of 50 to 100,000 at a minimum each in a city. So for anything 2 to 10 units, or maybe even 2 to 15, you're probably still you're going to be in areas with at least 10,000 people. I would have to think. The demand has to be there. The population size isn't I mean, we do look at it. It's not the number one metrics we look at. Again, we look at employers, how close, people are to employment base, and are there any new jobs coming, any new supply on the market, or coming to the market. We do look at the population, because that's going to be your tenant base that you can pull from. And then if it grows by 2%, next year, then that's great. You just add it to, that number, and you have that many more tenants. So yeah, it is something we consider, but I think for some of the smaller properties, I think you could be a little bit, you could probably chase a little bit better yield in some of these smaller markets with less people living there, but still good workforce type of areas.
And since you're vertically integrated, I mean, that obviously saves you in labor and costs, and you have more control on the deal. When you're going into doing a value add type of transaction, are you doing anything different than maybe the people out there? Do you have kind of your own sizzle features you add to properties that, like dog parks or anything? Or are you just really going in and you just, from day one, these are way under market, and we can do a light cosmetic rehab and increase rents by $400 or $500 a unit or whatever. And then you also have to figure out how to break that lease, right? You don't move it all at once usually. So what's the process of when you're looking at on a value add deal? How are you determining like how you're gonna start doing the lease ups and strategically maybe getting rid of some of the tenants? I mean, I know that could be a process, especially with COVID. How were you guys able to manage success in like the changing market we were just in?
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hello, Beau here, host of the Investor Financing Podcast. Are you a lender, real estate professional, or vendor that provides products or services within the real estate investing and business owner space? We are offering a few sponsorship opportunities to get in front of a highly targeted audience. If you're interested, please click the link below for further information. We look forward to talking with you. Thanks. Make it a great day.
Yeah, I mean, we're pretty aggressive. You have to do cash flow projections and have adequate reserves. One property, there was 50 tenants, and they were all month to month, and we sent everybody right away with notice. And thank God we did that, because then that was in basically January 2020. So everybody got their note, their 30, I think it was a 30-day notice, sign a new lease. Here's what we're offering. And most of them signed. I think 70% of them signed within like a 3-month period, which is great. After that, we probably would have had some challenges, people fighting us and whatnot. But, now we're looking at a staggered schedule. Obviously, we're looking at when leases expire. Pretty much when leases expire, at this point, we'll turn the unit month to month, depends how many there are. If it's the whole building, we're not just going to send out a notice again. We're kind of staggering it out a little bit more than what we did in the past. In the markets we operate in, I don't think there's any eviction moratorium in the United States in any city anymore. And I think LA just lifted theirs, or maybe I'm wrong. It's even without the eviction moratoriums, it's still taking time to get cases heard. So it does take some time. So we just want to be aware of that and protect, the cash flow coming in, and being able to still service debt and still pay good distributions that we promised, or not promised, but we expect. And, it's more of where are we at with cash flow, where are we at with the business plan, where are we at, with the rent roll, how many can we raise this month if they're month to month? Okay, should we do 5 this month, and then maybe we'll do another 5 next month, and kind of, we like to do things quick. We really do. And we're not afraid to have a little bit of vacancy, and then have a little bit more of a lease up. But as long as the demand is there, and the units are nicer and the market commands the premium, you should have no problem getting, a better tenant. Or, we try to work with the existing tenants if they want to stay. We're not just going in there and raising rent for no reason. We're offering upgrades, and a lot of the tenants appreciate that. We are trying to improve communities too. So tenants to appreciate that, and 7 out of 10 stay, and the ones that don't, probably not the ones we want anyway.
Nice. And when you're doing these rehabs, do you have your own construction crew now, or you really just sub all that out, or do you have an in-house construction crew?
Yeah, we have our preferred vendors and contractors that we work with. We're pretty much vertically integrated, except that. So property management's integrated, leasing, you know, uh, acquisitions. Pretty much everything else is integrated except the construction.
So, I mean, prior to you actually going out on your own, you really you really did this for a profession. You were really underwriting and operating, syndicated deals. And then what just clicked? Was it just the fact that now you had enough cash flow where you said, okay, I got to go out on my own? Or, I mean, was that in the back of your mind for a long time, or was it like you just decided, hey, I'm going to go out on my own. I've been doing this for a long time. I know how to do everything in this business. What really motivated you? Was it you wanted to get a certain amount of doors under ownership, and then you said, okay, I can breathe. I'm giving up the W-2 or the paycheck. And what really got you to transition over? Did you have a goal for yourself, or?
Yeah, that was definitely on my mind. I left when I had 100 and something, 110 maybe units. And then I had another project lined up right behind that too. So for me, I looked at it of transitioning into a new job almost, but it was for myself. So it was a 1-to-1 lateral move, but it was still taking a risk. And I think I was 25 or 26 at the time. And I figured if I'm not going to do it now, I'm never going to do it. So why not take the risk now, before getting married and having kids and whatnot? So, the personal decision, and for me as well, I was passionate about real estate. I really loved the business. I loved, the company I used to work for too, and everybody there. I think the asset class I wasn't 100% on board with, office. And obviously we're seeing challenges now with that asset class, given the pandemic's lingering effects. Hopefully it does fully recover, but we'll see. And that was a big part of it too. But really the part of it was I was able to see from that first deal I bought on my own, even though it wasn't a lot of money coming in every month, maybe it was $800 in positive cash flow after expenses and the mortgage, just coming in my pocket, not really doing too much. After it was stabilized, I just saw the power of that, and I wanted to do, if I could buy, 10 of these and have the same type of cash flow, that's obviously, it's okay, but it's a start, and then you kind of build upon that. I just love that idea, and then I wouldn't have to worry about the 9-to-5 type of lifestyle, even though it was more than that. But yeah.
That makes sense. Yeah, we have a lot of people that listen, and we talk to other operators, sponsors, and it's like, it's interesting to hear the dynamics, because everybody knows, like, hey, if I could do it for myself, I want to. A lot of people are a little scared, right? It's making a big jump to like, hey, I could do this, and you did it at a pretty young age, so that's great, right? Like, because you did it before you got married and had the stress.
Baby steps.
Baby steps. Yeah, but a lot of people I just interviewed a gentleman. He already has it like he's going to quit his job on 2025. So 3 years from now, he has got a good job. And it was an interesting story, because he's like, well, they're closing. He works doing security, and they closed the base down. He does like nuclear security. And he's like on his way to get there. And he just set the date where, some people, but I think if you're always building up your recurring revenue, then it makes it easier to transition, because you go, okay, I can cover all my expenses. And then if you could focus all your efforts to finding more deals. How are you guys actively, do you guys do direct to seller marketing, or really it's just you building broker relationships?
Yeah, it's more on the commercial side. When I say commercial, anything like 10 units or over, really. It's really broker relationships in my experience. I'm sure there's one-offs where you can go direct to seller. I don't think we've ever bought a couple direct to seller deals. 90% of ours are with the broker. Some of them come to us before it hits the market, or hey, we already own in this market, and a broker just calls us saying, hey, I have my client right behind you. He's got 50 units right behind you. He doesn't want to put it on the market. You have an interest in it. That's how we got our second syndication, actually. But yeah, I would say 90% are with, through those broker relationships. Sometimes they find us, but we find them as well, and we try to, I've kind of leveraged some of the relationships I built when I worked for my prior firm with like CBREs and the Cushmans of the world, but they have their own multifamily teams too that I was able to connect with, and that obviously was a huge help as well. So, yeah, it's most of it's kind of like off market, or if it's I haven't bought a marketed deal in a while, have to be honest with you, but most of it's kind of off market.
Yeah, the relationship, you're building relationships with brokers, and they're bringing you the deals because they know you might own in that market. What has been the biggest, maybe it's prior to your first syndication, what's been your biggest challenge that you felt in real estate where it might have taught you a good lesson or made you pivot on some of your thought process?
Yeah, it's still a challenge. Obviously, property management is tough. We do it in-house. We have systems set up for it. Hiring the right people from the get-go is key. It's a high turnover type of business to be in. But you can do things to maintain your employees and keep people happy and maintain smooth operations. And I think from the get-go, we were a little sloppy. And we still have areas to improve upon, but hiring the wrong maintenance technician or leasing agent could really kill you. Because they're the ones that are going to be on the ground at your properties and making sure they're running smoothly. So I think we made some mistakes in the beginning with some of the people we picked. Didn't really do a background check, didn't really do criminal check, other things like that, and ran into some issues. But now we know what to look for, and now we have great people. It is challenging, but you learn as you go, and as long as you learn and apply, the solution to your mistake, you should be fine moving. Hopefully, you'll be fine moving forward or in a better spot.
And what about like on some of your value add deals where maybe you acquired with a bridge loan, and then with rates ticking up, and they might continue to tick up probably. What's the model like right now? Are you trying to kind of push any refinances because of knowing that maybe a year from now, when you were planning to refi, it might not be as good of a time as it is now?
Yeah. We don't have too much bridge debt. We have some, and the bridge debt that we do have, they're actually kind of lower loan to cost, and the interest rate now is sub 2%. So if they go up if the Fed funds rate goes up 100, it goes up 200 basis points, we're still in the 4% range. And we'll probably be done with our business plan within a year on some of those bridge products. So not too concerned. We might just sell them. We won't even refi. But no, not too concerned. We like to take on fixed rate debt if we can. The value add deals, it's attractive to get bridge money. We just got to be careful, like you said, with some of the rates anticipated to go up. Not sure how much they're going to go up. I have my own opinions, but that's a whole different topic. And but we feel comfortable with the leverage that we're at and where we're at with those business plans on some of those assets that we took out bridge debt on. I could probably sell those assets for 50% more than what we bought them at. And like 25% of the rent rolls are already done. But again, that's a function of how hot the market is right now. It will turn at some point, by how much nobody really knows, but we're just being cautious with the type of debt we put on, because we don't want to get stuck in a shitty situation where we're having to, you're doing a capital call on a refi and property's worth less. That's the worst thing you want to do. So, being very aware of that.
When you first did your first capital raise, your syndication, did you have an experience at in your prior career raising capital, or was this like a first for you?
Yep.
Oh, you did.
Yes,
So
I did it. Yep.
Yeah. And so I know you have a business partner. What are you, more of the analytical? You got the economics degree and so forth. Like, what are your roles? How'd you guys come together, and how do you find the good team member or partner in multifamily syndication?
Yeah. We kind of do everything together for the most part. I obviously come from the, somewhat institutional background, and, he's really good at the property management side of it and building the team and finding good people and, trying to oversee the boots on the ground, and that's obviously very, very important. And then, we both do the acquisitions. I do the reporting because I have that experience. And we both try to, raise capital. We both do. It's a pretty cool partnership that we have. Responsibilities are delegated pretty evenly. That we don't feel like one person is doing more work than the other. It's not like that or whatnot. But yeah, if you could define your roles, the easier it's going to be to, make your company more successful.
Do you use any kind of books or guidelines that you really like for personal development or business? Any concept that you like that you could recommend?
Yeah. Always listening to different podcasts, different multifamily real estate podcasts, some personal development podcasts as well, some books. My favorite is the Miracle Morning, which I have to start again because I kind of lost it a little bit. But
Hal Elrod, I know him. He's a great guy.
Yeah. Heard he's great. I haven't met him, but I really like that book, and really changed my life. There's a couple books that help change philosophy and mindset. That's very important too in this business too, because you're going to strike out a lot in finding deals. I mean, especially if you're trying to grow your business and assets. We're doing a deal right now where you got to be patient. You got to have some patience too. I know, it's hard because you try to look for as many deals as you can, but you just got to make sure you're doing the right deals. So patience is key, but hopefully if you have enough patience and you know what you're looking for, you'll be successful.
That's great advice. Anthony, where can people follow you? Where's the best place to send people if they're interested in learning more about your business and maybe your podcast? Where's a good place?
Yeah, definitely. We have a free ebook. It's called How to Leave Your 9 to 5 through Financial Independence. You can just actually download that from our website, redknightproperties.com. That's Red Knight with a K. And then once you get that ebook, it'll have an email with all my information on it. So it'll have my my email, my Facebook, Instagram, Twitter, etc. You can find me on those platforms as well, Anthony Scandariato or Red Knight Properties. But yeah, best way is our website. Get that ebook, and then we'll stay in touch.
Awesome. Well, thank you so much for this conversation. I really appreciate it, and it's great to talk to sponsors all over the countryside and learn from them. And I know our viewers watching will enjoy the conversation we had. Any closing words to the audience about investing or getting started or maybe thinking bigger?
Yeah, like we talked about before, kind of the transition from the 9 to 5, and it sounds like you spoke to someone who has a plan as well. And I have other people who try to do co-GPs, etc., and they think they're going to make $500,000 in the first year just from co-GPing deals. And I said, that's not the way it works. It just, you gotta start somewhere and build up. So buying a duplex, buying a triplex or whatever, just get your foot in the door. Something that makes sense though. You don't want to buy the wrong investment, but that gets you on a path of where you want to be. Don't be afraid.
All right, perfect. Well, thank you everybody for watching, and thank you, Anthony. Please like and subscribe, and we'll see you on the next episode.
All right.